In this video, we'll learn why and how accountants book adjustments for accrued expenses. Many expense items are paid for, recorded, and used in the same accounting period. For instance, the company purchases supplies and uses them the same month. The company might advertise on a social media site and pays for it in the same month. But that isn't always the case. We previously talked about prepaid expenses. In the case of prepaid expenses such as prepaid rent, the company pays the amount first and uses it later. However, some expense items are used in one period but paid for in a later period. For instance, electricity and gas is used before the utility company bills for the usage. Telephone services are often used first before they're billed. Our financial statements would not give us a clear picture of how much our profit was for a specific month if we don't put the expenses in the month they belong. For us to match revenue and expenses, we accrue for these expenses in the period in which they are incurred. Accountants spend quite a bit of time at month end on ensuring that all expenses have been recorded for the period in which they belong, meaning the expenses were incurred. Now, our textbook focuses only on accrued salaries, payroll taxes, and interest on notes payable. In practice, though, there are many examples. Outside CPA or law firm has performed services, but they haven't yet been billed. Utilities, phone bills, even a lawsuit with a high probability of success if it can be estimated. In this class, we're covering the basics, but subsequent accounting classes will focus on how to determine if you have to accrue for an expense. Quite often, it is a complex decision. For instance, in healthcare, it's very common for a state or federal agency to claim that a company owes them money. However, often the initial claim includes a lot of data that is not even valid, which can only be determined after all the data has been analyzed. Companies spend a lot of time to determine if a liability exists with a high degree of likelihood that the amount can be estimated and when the accrued expense can be recorded. A very common accrued expense is accrued salaries. Payroll checks are often issued on the Friday following the 1 or 2 week payroll time period, and for instance, on April 22nd for the payroll period from April 4th to April 17th. That would mean that the incurred period from 4/4 to 4/17 and the pay date of 4/22 are all in the same month. However, the prior payroll period spanned 2 months. The payroll period from March 21st to April 3rd is paid on April 8th. So what should you do before you close the ledgers for March? In this case, you would look at the payroll cards for March 21st to March 31st and estimate the amount that belongs into the March payroll period based on the actual time. Or what really happens quite often in practice is that you look at the prior payroll period and prorate the amount of payroll for 9 workdays. For instance, if the prior payroll period had gross wages of $24,000 for 10 workdays, you would accrue the payroll period from March 21st to March 31st for $21,600 for 9 workdays. And the entry to accrue for the March wages would be a debit to salaries expense and a credit to salaries payable for $21,600. So keep in mind that in practice, accounting programs allow you to auto-reverse accruals at the beginning of the next accounting period to avoid that you leave accruals on your books without reassessing whether the accrual is still needed. A related topic to accrued salaries or wages is accrued payroll taxes. Payroll taxes are not legally owed until the salaries are actually paid. However, businesses want to match revenue and expenses in the appropriate period and accrue the employer's payroll taxes even though the tax liabilities are technically not yet due. So let's calculate the accrued payroll taxes, assuming that the accrued payroll is $16,800. We calculate the various employer payroll taxes such as Social Security, Medicare tax, FUTA, and SUTA for a total of $2,293.20. To record the accrued payroll taxes, we debit payroll tax expense for $2,293.20 and credit Social Security tax payable $1,041.60, credit Medicare tax payable for $243.60, credit FUTA tax payable for $100.80, and credit SUTA tax payable for $907.20. Let's look at another example. Wages owed but not paid on December 31st, 2022 were $500. On 12/31/2022, the firm owed the employer's Social Security tax of $31 and Medicare tax of $7.25. For the first part, we debit wage expense for $500 and credit wages payable for $500. For the payroll tax accrual, we debit payroll tax expense for $38.25 and credit Social Security tax payable for $31 and Medicare tax payable for $7.25. So in addition to accrued salaries and wages and payroll taxes, there are many different expenses that accountants accrue for. Our textbook had an example of $20 accrued interest expense. However, most companies have a materiality threshold for instance, $1,000. That means that with some exceptions, the company would only accrue for an expense if it exceeds the materiality threshold. At month end, accountants will talk to many of the department managers to understand if there are any services that were delivered throughout the month, but the invoice has not yet been received. Accountants are not always aware of every vendor and every invoice and whether the service was already delivered. Communication with other teams and departments is therefore very important to gather the right information.